This is Mortgage Morning, and I'm Andy Baker. Here are the housing and mortgage stories shaping the market today. Happy New Year! Today is Thursday, January 1st, 2026. Here's what I've got for you today. Regulation watch. HUD pulls back on the 50-year mortgage idea. The most consequential housing policy development over the past 24 hours came out of HUD, where Secretary Scott Turner signaled that the department is pulling back from the idea of allowing 50-year mortgage terms. Turner made the comments in an interview published Wednesday with HousingWire, where he described the proposal as very early and said the department needs to do much more research before considering anything that would materially extend mortgage amortization periods. Turner emphasized that while affordability remains a priority, HUD is focused on solutions that are secure and sustainable over the long term. That framing is important. This wasn't a walk back buried in a technical memo. It was an on-the-record interview clearly designed to cool expectations after the idea gained traction and criticism inside the housing and mortgage industry. Turner also acknowledged that ultra-long loan terms raise concerns beyond borrower payments, including downstream effects on the broader housing finance system. While he didn't explicitly reference securitization markets, the implication was clear. Loan structures that materially change cash flow timing and equity buildup create complications for FHA insurance, Ginnie Mae execution, and the institutional buyers who ultimately absorb that risk. Some quick context: why the 50-year mortgage idea mattered. The appeal of a 50-year mortgage is straightforward. Extending the amortization period lowers the monthly payment, sometimes enough to move a borrower from just out of reach to technically qualified. In a high-rate environment, that can look like an elegant workaround. The trade-offs are less elegant. Equity accumulation slows dramatically, borrowers remain highly leveraged for much longer, and exit flexibility shrinks. From a system perspective, longer-dated loans change prepayment behavior and duration risk, issues that don't fall on borrowers alone, but on insurers, guarantors, and ultimately the capital markets that fund housing at scale. Turner's comments suggest HUD is sensitive to that broader risk chain. Rather than framing the issue purely as borrower relief, he emphasized durability, a sign that the department is wary of policies that solve today's affordability problem by pushing risk further out into the system. There was no separate White House statement following the interview, which itself is telling. The administration appears content to let HUD slow the conversation without escalating it politically. For lenders and brokers, the near-term takeaway is simple. 50-year FHA mortgages are not coming anytime soon, and any future affordability proposals are likely to be scrutinized through the lens of capital markets impact, not just payment math. Market signals. Mortgage rates close 2025 at their lowest weekly level. One clean data point to close out the year: mortgage rates ended 2025 at their lowest weekly average. According to Freddie Mac's latest primary mortgage market survey, the average 30-year fixed rate finished the year at 6.15%, down slightly from the prior week and well below where rates started the year, when averages were hovering closer to 6.9%. That doesn't make mortgages cheap, but it does matter as a psychological and practical baseline heading into 2026. The market spent much of last year adjusting to the idea that rates would stay higher for longer. Ending the year near the bottom of the range reinforces that stability, even if it doesn't unlock a surge in demand. In the bond market, yields have eased modestly from their mid-year highs. The 10-year Treasury is now sitting at 4.163%, down from peaks around 4.8% earlier in 2025. The move has been incremental, not dramatic, but it's enough to influence pricing at the margin and set expectations for early January trading. Lender moves, Rocket stock slides in year-end trading. On the capital markets side, Rocket Companies saw its stock fall about 3.5% in Wednesday's session, underperforming both the broader market and several peers. There was no single announcement driving the move. Instead, it appears to reflect a mix of year-end positioning and investor caution around origination volume and margins heading into early 2026. In a market where sentiment often moves ahead of fundamentals, these kinds of declines can signal skepticism about near-term earnings narratives rather than a reaction to current performance. It's not a crisis signal, but it is a reminder that public market investors remain selective and that mortgage platforms are being judged less on scale and more on perceived resilience in a slow, uneven recovery. What we're also watching: rental demand and next week's data calendar. On the rental side, fresh market data shows demand continuing to accelerate in several large metros where affordability has pushed would-be buyers to the sidelines. Recent reports show year-over-year rental demand increases of about 10.8% in Atlanta, 9.5% in Orlando, and 8.8% in Charlotte, driven by population inflows and limited new supply. These aren't marginal changes. They suggest sustained pressure in rental markets that could influence when and whether renters transition back towards homeownership. Looking ahead to next week, there are two dates that matter. Monday, January 5th, the Employment Situation Report, including payroll growth, unemployment, and wage data. Markets will be watching not just job creation, but whether wage pressures remain sticky enough to complicate the Fed's path. And Friday, January 9th, the December Consumer Price Index, which will shape inflation expectations heading into the Fed's first meeting of the year. Together, these reports help define the macro backdrop for early 2026. Strong labor data combined with firm inflation would reinforce the idea that rates stay restrictive longer. Softer readings would reopen the conversation about easing, not immediately, but directionally. And that's it for Mortgage Morning. If you found this episode useful, follow the show, share it with someone in the biz. I'm Andy Baker. Thanks for listening.